And we are live.
Good. Well, welcome everybody to what number are we up to? Of course, Hangout number 6 is this?
Yep.
Yes.
Hangout number 6 for the asset pricing Coursera Hangout. And we've got usual Adam and Nina RTAs are with us, and Leonard also has joined us again. And Nick is supposed to join us by phone when he gets his internet connection working. So welcome everybody. Let's get going. Maybe we'll start with Leonard, since you're kind enough to join us again.
Okay. Well, here, this week we were discussing how bonds could be held as part of a portfolio. Since they've held to maturity, they actually earn their promised return. And we also were introducing more realistic modeling. So my question is, how would one factor in accounting regimes? Because under both IFRS and US GAAP, you have held to maturity available for sale trading, which monkey when you recognize income and actually might force volatility in that you really want to factor into your models. And the question is, would your pricing really factor in the fact that there's unwanted interim volatility that you might have to report anyway just because of the accounting rules?
Oh my God, Leonard, do you have to ask questions like that? Okay, let me try to put something, since we didn't do any of that stuff in this class. How can we use the concepts of the class to answer a question like that? One, you said something in there about how accounting rules, like the difference in hold to maturity and trading book assets, induces volatility. And let me push on that one a little bit. Now, that certainly induces something in an individual's trading strategy, but how does that affect prices?
Right.
If I have a rule, no tomatoes on, my religion says no tomatoes on Tuesday, that doesn't necessarily mean tomato prices are going to be lower on Tuesday.
Right.
Other people might buy more tomatoes on Tuesday, or suppliers might figure this out and smooth the supply of tomatoes over the weeks. The same is true in asset markets. There's all sorts of strange things that individuals do, but they don't seem to show up in prices, especially when the things that individuals do are, when the arbitrageurs can understand what the individuals do and meet them. Nobody's buying stocks in the middle of the night, and nonetheless the prices don't collapse in the middle of the night. Well, figure that out. So now there is a lot of interesting empirical work on downward sloping demand curves or whatever, how if a large body of traders does something, especially unexpectedly, that can affect prices, that can induce volatility. It certainly happened in the financial crisis when not many people were around and big orders hit markets. So from the point of view of to first order, from this class we have this kind of frictionless market where the prices don't depend on institutional constraints like that. I'm going to interpret your question as, isn't that a stupid thing to do, given that lots of traders do face institutional constraints? And I can say, well, not necessarily. All you need is some deep market arbitrageurs out there, and then the prices won't. And then now it's a very deep portfolio problem. If you are a bank, you have a hold to maturity book. Then there's this problem of marking to market. When you report things mark to market, regulators might get on your case about it, even if we all know those prices are going to recover later on. Those are difficult portfolio theory problems that I don't want to say much about, but not obviously asset pricing problems, or at least not to first order. So now you asked a question and I gave a totally unrelated answer. And
well, my question more was, are any of these effects so large? You gave the example of the religion not letting you buy tomatoes on Tuesday. Are some of these effects big enough where it does move the market? I'm thinking sort of like insurance companies wanting really long portfolios and willing to, say, have private placements, while banks need high levels of liquidity, so perhaps they're big enough to have some kind of effect?
Well, it depends what you mean by big. Things that are small to me can be very big to a hedge fund that knows how to leverage 1,000 to 1. Yes, especially in fixed income, there are spreads that come down to these kinds of liquidity and institutional features. You mentioned certainly I know there were some studies about the UK passed regulations requiring pension funds to hold long-term bonds and to stop this pretense that they were to earn 9% on stocks and pay the 2%
right, exactly.
bonds, and some claim that drove down the long end of the yield curve because there was this massive more demand for bonds. That shouldn't really be there in the end, but with a lot of people, in the end it is all supply and demand. There's a lot of smaller spreads. I've seen studies about one gorgeous one. Mark Carhart wrote this because the title is so great. Why is Santa kind to hedge funds? About in tiny end of the year price increases that seem to be hedge funds pushing prices around. So we're talking about a couple basis points, which if markets are within 10 basis points of efficient, are they mostly efficient or mostly not? Well, if you can do a huge spread trade, 10 basis points is to die for. Lots of the spreads in bonds are that way. The on-the-run, off-the-run spread is the most famous. There's two kinds of treasury bonds, the most recently issued and the ones that were issued a long time ago and have now got younger. They can be economically equivalent but trade at 10, 20 basis points difference. That's an arbitrage opportunity, but you have to be a savvy trader to take advantage of it. Now, is that the kind of thing you had in mind?
Yeah, that's more what I had in mind. Whether there were any real effects out there that were big enough to move the market. Yeah.
Yeah. So the question is, move the market by how much?
Right.
And if two securities are selling for 10 basis points difference, do you call that a lot or do you call that a little? Well, that depends on that depends on your trading abilities. Yeah. The bigger question, I will be honest, that's more unresolved. If you asked Bob Schiller that question, he would say, of course, the entire movement of the stock market is from waves of sentiment and pessimism and optimism and trading moving markets and so forth. I think of that as well, we don't really understand the discount rate yet. I put the same observation, changes in the marginal rate of substitution are driving markets up or down, and I wish I understood where they came from. Mm-hmm. But now we're verging off into philosophy. Let's try to keep our vow to do something vaguely related to what we're doing in the class.
You want something more germane? I also asked as an alternate question about possibly using principal component analysis just to pull off, 2 or 3 factors for a multi-factor model, whether or not you actually had a theory underlying why these might actually drive the markets. If you just do some, how much data mining is, when you're talking about fishing and trying to find models, how much of this is just pure fishing and thrown out as statistical garbage, and how much can you actually do some PCA and get some factors?
Yeah, so I'm a huge fan of principal components analysis, and there's sort of a theorem that says variances are easy to measure and means are hard to measure. So that you put anything together. Looks like Charlie's with us this week, but level, slope, and curvature describes everything. Seems to be kind of a law of nature when you do principal components analysis. Now, to what extent is it fishing? Let's distinguish. So we use the word factor. The word factor gets used in many different ways, and it's very confusing. One sense the word factor is the tendency of assets to move together, factors and variance. That's what principal components analysis is about. Can we find tendencies of securities to move together? Not about are they predictable, not about the expected returns and so forth, right? And that's the kind of factor analysis you had in mind?
Yeah, well, I had in mind that since what we're really doing is finding the axes of a spanning vector space, that if you're doing 3 components, you're saying, okay, we're in R3 and here are your 3 vectors, and you can set prices based on them, or you can find 5 factors, et cetera.
Yeah,
or is that too mathematical way of thinking?
No, that's exactly what we do, and I think that's extremely useful. So it is a definite fact that large groups of securities tend to move together, that the risks are correlated across assets. The number one is that the whole market goes up and down, and that just about everybody seems to go up and down. Industry groupings move together, size moves together, value moves together, and you can reduce a lot of asset pricing to the prices on these common components. That's, I think, the Frama and French's paper, which we're going to study a lot, kind of shows us how to do that. Now, what that does is it reduces, I think you put it very nicely, it reduces the dimensionality of the problem. A lot of the problem is figuring out how do individual securities line up against their risks to market, small minus big, high minus low, book to market, and so forth. And then, so that's useful if you're kind of a practitioner. Well, there's these big factors that I can hedge, that I kind of understand the pricing. Now I'm looking to trade away from those factors. That's useful. That's useful, I think, for academics because it means we don't have to figure out. That factor analysis approach just reduces the problem. Now I got 4 or 5 big things that I don't understand instead of 1,000 big things I don't understand. And so the academic has to understand, well, why is there a value premium? And the investor has to understand that. It reduces the investing into 2 components. First, how much market value, small minus big, and so forth, do I want to own? And that's, where do those premiums come from is important. And then how do I want to trade away from those? So I think it's a very valuable exercise. The interesting thing, the weird thing that came out of the whole Farmer-French exercise, so I want to go back to fishing. For 20 years, people used PCA on the individual stocks and kind of got garbage out of it. So there's a lot of the commercial factor models, you'll see there's just 60, 70 factors, and they're unstable, and the betas are unstable, and things wander over time, and you start to smell like last week's fishes in the fridge, right? And it's kind of interesting, despite the theorem that variances are well measured, where we got a useful factor structure, Farmer-French started categorizing stocks by things like their book-to-market ratio, their size, and so forth. Now, among the categories, we see a stable, useful factor structure where we didn't see a stable, useful factor structure just throwing PCA at it. So what turned out to be successful was first categorizing stocks by a whole vector of things, size, book to market, industry, and then doing PCA on those categories rather than the individual stocks. That turned out to be the trick to finding a stable structure in asset markets.
Thank you.
Now that also violates the rule about having anything to do with what we're doing this week, I think. But we are going to do PCA later on in the class, and I think it's a lovely tool. So this is a great advertisement. If the rest of you listening are getting tired, hang in there. Portfolio theory is coming. Principal components analysis is coming. Farmer-French is coming. Don't leave us yet.
I had a brief comment to Leonard's first question about whether sort of potential behavioral anomalies or institutional frictions affect asset pricing. And I think John's comments to look at what's first order and second order is important to reiterate. My behavioral deficiencies will not change asset prices because I'm so small, and there might be deep pocket arbitrageurs or hedge funds out there that can arbitrage that away. That said, during the financial crisis, we did see that these arbitrageurs themselves had a run on liquidity. So some of the relationships that usually are arbitraged away, for example, the covered interest rate parity, not the uncovered, but actually the covered interest rate parity blew up. And other spreads such as the basis spread on convertible bond arbitrage actually had a lot of the credit spread that are usually tiny blew up. And that was because what we think of as the marginal investor, the hedge fund or the investment bank, themselves faced runs.
Blew up, I think, is a little bit of an exaggeration here. Something that
relative to the time series up until then.
Something that was normally 2 basis points blew up to 10 to 20 basis points in a movement of many percentage points in the level. So 2 things that the covered interest parity, so read discount rates, because I have a great graph. The covered interest parity, usually, 2 ways of getting the same security were right like this. Then the crisis came, boom, everything went down, and, whoops, I went off the screen, and then a little spread opened up. And the spread opened up, so it was a big spread to the usual highly leveraged arbitrageurs who would have taken advantage of it. But it wasn't a very big spread for long-only investors. So if you walked into, I'm going to tell a story again that I've told before. If you walk into, like the University of Chicago endowment office in December of 2008 and say, I got a deal for you. You're earning 2% on your cash now. I can give you 2.1% by this covered arbitrage blah, blah, blah thing. Yeah, that's a 0.1% that shouldn't be there, but they would laugh you out of the office because they would say, oh, you've got to be kidding. We're facing all these crises now. 0.1% is just not worth the long-only money jumping in right now. But but your story is right, and it spreads opened up. But it's important to remember what happened. They opened up in a crisis, in a once-in-a-generation crisis, where the usual mechanisms of supplying liquidity or whatever were having a huge problem. And you know, we set up institutions that are pretty good, that can handle 99%, and then the 1% huge demand comes, and they blow up for a while. But that doesn't mean that they blow up forever, and that doesn't mean that they remain blown up. But yeah, that's and to Leonard's question, this is like some of the most interesting thing that's going on in asset pricing research right now, is understanding these frictions, these arbitrage frictions, and where they come from. Nina, it sounds like you want to say something.
Yeah, I have a comment on the second question from Leonard about principal component analysis.
Please.
I want to say that it works not only for stocks but also on the currency market. And there is a famous paper by Lustig, Rosanna Verdelhand, who show that you can have first factor, which is the average return of all currencies against the dollar. It would be like market factor. Or like level factor, and you can have the second slope factor, which would be the same as shorting low interest rate currencies and going long into high interest rate currencies. And those two factors, dollar factor and the HML factor, they explain maybe 70% of currency returns.
No, and so that was a great, the Lustig-Rusinov-Verdelhand paper is a great paper. I'm glad you brought it up, because it also makes the point, if you decide, oh, I'm going to do principal components of currencies, and you take all the countries in the world and you do their currencies and just apply PCA, you get a level factor, kind of everybody against the dollar, and then you can't really see much of anything else that's stable. I mean, you know, maybe Europe moves together, you get sort of regional factors maybe, but nothing very stable, and nothing that helps you understand the risk premium, the carry trade that investing in high interest rate countries makes sense. What Lustig-Rusinov and Verdelhand did, they didn't apply PCA to the countries. They sorted the countries into countries that have high interest rate spreads relative to the dollar and low interest rate spreads relative to the dollar. And then they did PCA on those sorts. So what moves together, exactly as Nina described it, what moves together is not Japan and China. What moves together is the high interest rate, all the high interest rate countries, and if Japan is temporarily a high interest rate country, it moves together, but if Japan becomes a low interest rate country, it moves the other way. So by doing PCA on the characteristics, oh, yes, good, we have someone else with us. George, by doing PCA on the characteristics, they found a stable PCA analysis, and they found the second factor that accounts for that accounts at least mechanically for this carry trade risk premium. Just as they just applied Fama and French to currencies, low-hanging fruit. No one else had thought to do it for like 20 years, and bingo, they get one of the best papers in international finance. So there is still low-hanging fruit out there. Yes, thanks. So who's with us now? George. Hello.
Hello.
Since you're the new guy, why don't you introduce yourself and ask a question?
My name is George Christopoulos. I live in Greece, and I have one question. I think I have actually two questions.
Well, do one at a time.
Yep. We tried to incorporate some job effects, some outside income effects. What are the conditions in order for those effects to cancel out each other on the aggregate? For example, it's me, I'm the same person. Sometimes I have a better job than I deserve, and sometimes I have a worse job than I deserve. But on the aggregate, let's say that I should be, let's say my expected value on luck be 0. I can't be so much lucky this year and not lucky the other year. And if we have like 1 million people, so those effects should cancel out. What are the conditions that those effects to cancel each other, so we don't have to worry about outside income effects?
Absolutely. Well, so it depends what question we're asking, as always. There are many factors that are there and are important in the variance of returns and are important for individual hedging, but aren't priced. So there's lots of things that affect one group of people one way. The classic example is something affect one group of people one way and the other group of people another way. What's going to happen? The people who are all happy about it, they want to hedge one direction, and the people who are all unhappy about it want to hedge the other direction. Now, that factor like that, I'm trying to think of an example. A factor like that is well, let's think about something that you know, a shift. If there's some sort of shock that shifts income from labor to capital, so that, you know, right? So workers do worse and owners do better. So people are talking a lot about, you know, like more union powers and, you know, something like that. Now that's a shift that people would want to insure against. So it would be very important for individual portfolios. So the number one rule of portfolio formation is if you own a business, don't invest in stocks highly correlated with your own business. Invest in stocks ideally negatively correlated with your own business, and that way you essentially buy insurance. So a factor, let's think about a factor like that. Now, so there's a factor, let's say the industry factor, the Greek industry factor, right? You should not be investing in the Greek industry factor. I don't mean that as a directional trade. I mean that simply as, you know, you want to hedge your portfolio. We should be investing in the Greek industry factor, right? Because it's, you know, it's not correlated with what we do. So a factor like that is something very important for individual investment. It's very important for variance and hedging, but it might not be priced because the same number of people want to buy as want to sell. And the beauty of markets is that markets are really they have three big functions. They're a big market for information, they're a big market for insurance, and they're a place to earn a risk premium. We put all our attention on this risk premium, but the first two are far more important in the way the grand world works. So a factor could be something very important for you to hedge your own income. It could be a great way to transfer risk. Most of the common movements should be things like that they're not priced. They're big pieces. You know, Leonard was asking about PCA. Industry factors are big factors in common movement. Industries all move together. Industry portfolios are really important for people they use to hedge. Short your own industry portfolio. You should. Nobody ever does, but you should, because that buys you insurance. But industry portfolios aren't priced. There's no extra return for holding an industry portfolio. Why is that? Well, you sell, everybody else buys, and supply equals demand, and it doesn't show up the price. In order to move the price, something like the value effect, something like the market as a whole, everybody's trying to sell. More people are trying to sell and trying to buy, and that's what generates the premium. So I'm sorry I went on a bit. You just asked such an important question. Let me try to summarize all that. There are many factors. There's certainly the size, book to market factors that we're talking about that generate premiums, but there's lots of other factors that don't generate premium. Industry portfolios, country grouping, so forth. Those are sources of common movement. You don't get an extra expected return for holding them, but they're still vitally important for portfolios, for risk management, for transferring risk. I think I overdid it, but you just asked such an important question. Did you have a second question, or Adam and Nina, do you want to help me out on that one?
I think you covered it.
In great detail. Okay, George, you said you had a second question.
Yep, I have another one. Sometimes in the lectures it is stated mu equals alpha minus beta f, and sometimes in the book I read mu equals alpha plus beta times f. Is it the same thing, or am I just confused?
Let's see. I don't think I wrote either of those, but I brought along my handy-dandy board, and I'm sure this is a common confusion. So, except I don't have my easel with me today. So let's see if I can get this. So, what are some equations? So I've written. Is this the one you had in mind? I have m equals a minus bf.
Yes, this one.
I would expect you to get the Greek alphabet wrong, but.
Yes, I did. I said m mu instead of m.
Okay.
It is m.
Yeah, so ma minus bf, or sometimes m equals a plus bf, right? Okay, this is a different. So that's just as you probably have noticed, I'm very prone to typos and or thinkos or inconsistent notation. I try hard. these two make no difference because, of course, in their the reason I do this is typically that in that version the sign will be negative. For example, let's take an example. Our canonical example is m equals, let's take beta times ct plus 1 over ct to the minus gamma. That's our typical m, which we then approximate as e to the minus delta, e to the minus gamma, delta ct plus 1, right? Or approximately 1 minus delta minus gamma delta ct plus 1. Can you still see, Ari? Okay. And so that would be the thing we're calling A, and that would be the thing we're calling B, and that would be the thing we're calling F. So you can see in this example, in our standard example, you can get an m that's a linear function of a factor, and that usually is a negative sign. And of course, that depends on the units of the factor. But usually we have factors that are good things. So up means good and down means bad, like consumption growth. Marginal utility is hunger. So the more you consume, the less you're hungry. So usually marginal utility growth is negatively related to factors if the units of the factor are good is up and bad is down. Of course, sometimes factors, if we used an unemployment rate as a factor, then we'd have to have a positive B. So I just did that. I try to put the negative sign in up there because it's awfully nice to have coefficients that are positive. It's less confusing for students if coefficients are positive. But of course, we're all good at negative numbers, so it's not really a technical problem if the coefficient is negative. And then sometimes I forgot to do it, but then you have to remember that B is typically a negative number.
Okay.
Now, is that the question?
Yes.
I never know if I've actually answered the question. So, George, you get the prize. This is the first time, I think, in 6 weeks of Hangouts that somebody's actually asked a question about the class that we're supposed to be taking. I appreciate that. There's a lot of these confusions, and I think it's important for us to unconfuse things. Let's go to Adam and Nina. What do you got for this week? And we'll also ask George and Leonard. Don't fall asleep here, because you may be able to help us. Our job is to try to figure out what's confusing people, and George and Leonard may be able to help us to figure out how things are helping or confusing people. So, Adam, what do you got?
Sure. I've got potentially a confusing question from Kim Jensen. He's based in London with an academic background in economics and a professional background in investing. He finds the course very interesting. He says, "Hi, I have a basic but hopefully important question. I'm struggling with the connection to the factor models. When we state P is equal to E of mx, M is B prime F, so what you wrote on the whiteboard right now, with F being factors. The regressions that I've seen with factor models, though, is R is equal to B prime F. So how do we go from one to the other?"
Okay. This is great. Let's try to. So let me put up the equations we just talked about. What we've talked about is price equals E. Just to restate. Whoops. Price equals E of mx. Or now, in the case of mostly what we're doing, as in most empirical finance, we're doing expected returns. So really, we're looking at 0 equals E of m times expected return, right? That's where we start our pricing models. And what we're looking at in our factor models is things of the form m equals a minus b times f. And in fact, just to make life simpler for these manipulations, notice if we've got excess returns, the level of m is not identified. If m works, 2 times m also works. So most of the time when doing excess returns, it's easy just to normalize and just choose 1 or choose E of m, right? Because the level of m isn't identified. So you can just pick that any way you want. It doesn't make any difference. Okay. So now the question was, how does that this is a great way to think about things. How does that relate to the other kind of thing we've looked at? We've looked at, I'll write the regression, RT plus 1, actually RET plus 1 equals A plus beta times factor T plus 1 plus error T plus 1, right? So as I digest the question, and Adam, help me, I think the question was, how is this different from that? Or is this, or I mean, this is MT plus 1 is BFT plus 1. And so we had two equations that look kind of the same, but they're not really the same. So what's the relationship between the two? Okay, answer. What do we do with this? Remember what we did with this equation, which is we plugged that in there, and we got our way to E of RE equals covariance of RE with M. Right? That implies that. I'm missing an E of M, but I'm not going to worry about that. And then we said that equals covariance of RE with factor times B. How are we doing on the equations?
Good.
Good? Yeah, you guys, when I do something stupid, you guys have to stop me. That's your job. The rest of you will know that they have a heart. There's a lot of work for them to do. Okay. Now, covariance is the numerator of a regression coefficient. So the next thing we did is we expressed that thing as beta, that's covariance divided by variance, times B times variance of F, and we called that thing lambda. So that's what we did. We did E of MR, looked at the factor model, and then we re-expressed E of MR in this terms and said expected return equals beta times lambda. Now, this beta, let me, hold on a second. I went and bought all these colored markers for a reason. This beta, I haven't gotten to use them yet, this beta is the same thing as that beta. So the regression of return on factors. This is the kind of factor model that Leonard was talking about earlier. It tells you if a common thing, if the market moves, how much does each security move? If the GDP moves, how much does each security move? This is like a principal components analysis. Right? Principal component says return equals a bunch of betas times a bunch of components. It's the description of the variance. This beta here is just a way of measuring, it's that covariance. It's an input into our model. So our model is about mean returns. It's about prices. That beta is a covariance, is an explanation of our mean returns. So these are, in fact, these look the same, but they have completely different status. This is just relating the discount factor to the pricing factor. It's an input into this equation, which is about mean returns, our understanding of mean returns, where does it come from? And then this, the beta and the usual beta models, is the way we measure that covariance. It's the way of measuring the right-hand side in the expected return beta representation. Guys, want to help me out? Explaining confusions is always hard. Adam, Nina, did I do a good job? Does that answer the question?
Yeah, I think you did.
Okay.
There's a follow-up question about the same material from let's see here, from David. David is a business analyst from Brazil with a background in applied math, and he had several questions about the chapter 1 textbook material. Sometimes and one of his questions was precisely as in this formulation. He says, when we derive the beta representation for excess returns, we define this lambda m as minus variance of m. And you call this lambda the market price of risk. Where does where does that name come from? And if lambda is negative, how can a non-positive value be a price?
Well, you have to pay them to take the garbage away. So non-positive values can be prices, but that's just a matter of definitions. If we choose the negative of a factor, it has a positive price. If we choose the factor itself, it has a negative price. Let me do the verbal one. We usually write expected return versus beta, right? And then we graph that's our graph of where things should be. And let's see, there's the risk-free rate. And did art on a Sunday morning. Let me just do it in the context of the cap. And there's the market return. So there's the expected return on the market, E of Rm minus Rf. And that is the same thing. We use the word lambda for that. So the capital asset pricing model is written expected return minus Rf equals beta times expected market return minus Rf, and that thing is also what we call lambda. So terminology, the lambda, people call lambda the market price of risk. Risk is beta, so this is a beta of 1. So you can think of how much beta you're taking as how much risk you're taking. How much are you invested in the market? Lambda, it really should be the market reward for risk, shouldn't it? Because it's for each unit of beta, how much expected return do you gain? In the cap, and you only gain expected return for taking this risk. So we could call lambda the market, how much the market pays you to take on beta risk. That's where I think the word comes from. Originally, it gets used in a lot of other contexts. In option pricing contexts, we'll talk about. So in other contexts, sort of the M equals A minus BF. We have found how that B thing controls the market prices of risk. Let me not get into that. I think I've done a good enough job of explaining where the term market price of risk comes from. It shows up in a lot of other formulas in roughly the same thing. Parameters that control risk premiums are called market prices of risk. And that's where it comes from. I would say be careful. Like factor, it's one of those words that gets used to describe different things in different equations, so not always with great consistency. Okay? Mina, you got something for us?
Yes.
And Leonard and George, if you can see something that we can do to help explain, don't feel embarrassed to pipe up and wave your hand or something. Nina will unmute you. But Nina, what you got for us?
I got some hopefully easier question for you. Eduardo Manuel Locke Maguruza has a question about geometric representation. He doesn't quite understand why the states are in the axis and are like continuous variables. He thinks that states are something like or rain or no rain. So he wants some of the explanation.
Nina, thank you. This is the kind of question I like to ask. A simple, very common confusion that I know the answer to. None of this business about mark to market on holding on the portfolio that you hold to maturity that I have no idea what to do with. Okay, let's think about the rain versus shine example. We have thought often about a discrete state space where one of two things will happen tomorrow: will rain or shine. And then associated with that, we've done pictures where we have things on the axes, which I've called state 1 and state 2, or state 1 is the same as rain, state 2 is the same as shine. Now, what's going on these are consistent. What goes on the axis here is not rain versus shine. What goes on the axis here is how much money do you get in the state rain versus how much money do you get in the state shine. And money is the continuous variable, not rain versus shine. What's discrete here, in this example, rain versus shine, that means I can use only 2 axes. I don't need an infinite number of axes to describe rain versus shine. But then how much money, so let's think about, Adam, you want to take a bet that, sorry, you guys got to see where I am. I'm in California. That's what it looks like outside. It's looked like that outside every single day for the last 3 months. I just wanted to needle poor Adam and Nina, who haven't seen things like that for months and months. Okay, so let's take a bet on whether it rains tomorrow in California. I'm sorry?
Here is shiny all year round.
Yeah. Well, we have a functional banking system, though. Sorry, just kidding. Actually, I'm not sure we have a functional banking system, but at least we don't know about ours yet. But sorry, I got to stop telling jokes. So what goes on the axis is how much how much money you get in the state range. So if we made a bet, how about let's bet I get $10 if it rains and I get $1 if it shines. We would put that here. That would be $10 in the state rain, $1 in the state shine. Of course, we could also have a different bet that's $11 in the state rain and $1 in the state shine. So that's on the what's on the axis is dollars in the state rain, and that's continuous, not the state itself.
Sorry, can you move the blackboard a bit?
Oh, yeah, thank you. I'm trying to.
Yeah.
So, yes, thank you, Nina. Mm-hmm. So what's on the axis is dollars in the state rain and dollars in the state shine. So what happens as we get lots and lots of states here? The state might be inches of rain rather than just rain versus shine. Sorry, inches. I'm being so American. Centimeters of rain. Now we get many more, and in fact, this could become a continuous random variable. Now we need 1, 2, 3. We need a continuous number of axes. So in fact, the mathematics of what we're doing is the Hilbert space mathematics, which really is infinite dimensional. And then you have smooth variables in an infinite number of axes. That's really the math we're doing. But we make it easy by using discrete states. Okay, so I beat this to death. The answer to the question was you're confusing the number of states with what's on the axes, which is the amount of dollars you get in each state. Or euros. Sorry, I don't mean to be parochial again. Let's see. Adam, got another one for us?
I do. I have a question from Marco. Marco is a financial analyst from Germany. He read in the quiz that testing the CAPM for alpha equal to 0, as opposed to big R squared, is relying heavily on general equilibrium feature of the CAPM. So his question is, what is meant by equilibrium here? To derive the CAPM pricing or return formula, one basically needs the optimality condition, one investor that maximizes a utility function and a budget constraint. If I'm not wrong, you then get a demand function. We talked about in a prior lecture with regard to P is equal to E of mx. But for a general equilibrium, one needs supply equals demand. The general equilibrium feature in the CAPM is, as far as I can see, that all security markets clear and the risk-free rate is in zero supply. Could you comment on this general equilibrium stuff?
Oh boy, yeah. Okay, let's talk about general. Let me just reiterate a graph that we did in the first week, which I think, to me, keeps. This is important. People forget about general equilibrium all the time. We thought about consumption in day t and consumption in day t plus 1, and Rp equals E of mx. The graphic version of what we're doing, P equals E of mx, or let's think about the rate of return. That's the rate of return in asset markets. And really what the economics of what we were doing was comparing that rate of return to a utility function. So this is the marginal rate of substitution, U prime of CT plus 1 over U prime of CT. That's the slope of that curve. And we said the rate of return was related to U prime of CT plus 1 over U prime of CT, right? So that's the sense in which we're doing consumption-based asset pricing. And we tend to, as Marco noticed, we tend to not talk a lot about the general equilibrium underpinnings of it. Now, there's three different possible general equilibrium underpinnings to this thing. One is we CT versus CT plus 1. Let's think about what the technologies could be. Let's add firms to this business. Firms see interest rates and they invest. There's an interest rate equals marginal product of capital condition. That's out there in general equilibrium. So how would this look from the firm side? Well, in general, from the firm side, it's going to look like firms are going to do. There's going to be a production possibility frontier for consumption today versus today tomorrow, and firms are also going to, they're going to set marginal product of capital, the marginal rate of transformation consumption today tomorrow to the rate of return, and then we put the whole thing together. Well, what happens is, the rate of return adjusts until we get This is the general case. So there's the general equilibrium underlying the CAPM. Now let's make this come alive a little bit. Suppose the risk premium on the market goes way down. Investors, suppose there's a savings glut, and investors are putting a lot of money into the market and want to save a lot. That'll drive rates of return down. Driving rates of return down, I'm not sure I can do this in pictures without making a mess, that induces people to invest and induces them to supply more shares to the market. When the price goes up, these firm side will issue more shares, and that will help to bring the prices down. So one way of seeing that is, well, does that happen? Is that, how strong is that? Well, there's a bunch of different possibilities for this technology. How much can, when the rate of return changes, how much can firms supply more shares to the market, and in supplying more shares to the market, can they satisfy this demand that people have? Well, there's three possibilities, extremes. Maybe the production technology looks like this. So this is the endowment economy, the coconuts technology. This is sort of the smooth, the right answer. But the other theoretical possibility is a linear technology. That's the storage technology, where companies can always transfer consumption from today till tomorrow. So let's try to bring this alive. Stock market goes up. Investors, there's a flight to, what are we calling now, a reach for yield. Investors want to hold a lot of stocks. And what do? They drive stock prices up. But how long can that last? Well, there we need to think about general equilibrium. If the general equilibrium looks like this, if the companies just have no investment ideas, there's just nothing they can do with new cash, if they're sort of like the tech companies out here who just pile it into the mattresses, then the stock prices will, in fact, this reach for yield will just drive the prices up, drive the expected returns down, and there's not much anyone can do about it. On the other hand, suppose the general equilibrium is flatter, that if prices go up, just a little bit, companies say, great, prices are up, I'm going to issue a lot of stock, I'm going to build a lot of factories. With those factories, I'm going to deliver you a lot more consumption tomorrow. Then what will happen is stock prices, the reach for yield, the demand for holding stocks, won't affect the expected returns. It won't affect prices all that much. It'll just lead to a big amount of quantity. What happens in the real world? What happens? This is my opinion and my next paper. So I hope. What happens in the real world is kind of like halfway in between. In the short run, so suppose there's this big glut. A lot of people want to save, and let's write a price over a book value. So what happens to stock prices relative to book value? In the short run, if people say, if the risk premium goes down, people want to invest a lot, they're going to drive prices up. But that price, it takes a while for companies to get the equity issues going, to get the investment going. So what happens, let's write investment here. What will happen to investment is investment will respond to that price increase. That's what will happen to investment. Since investment goes up, then share issues will go like that, issues. These companies will issue new shares from the market. That demand curve, so here's the supply curve moving out to meet the demand curve, and that eventually will bring the prices back down. So that's sort of the way I think the world works, which is kind of like the halfway. This is what it looks like with adjustment costs and slightly declining marginal products of capital, if you want to get technical, kind of halfway in between those two views. So that's where general equilibrium, okay, once again, you got a lecture out of a simple question. In the CAPM, the way we often think about it is it's just a fixed supply of shares and we're letting the price adjust. In fact, really, when you write down the models, the CAPM, the standard finance models assumed linear technology. They take the rates of return as given, and if you look at them, it's really about we all can rebalance, we all can invest and disinvest frictionlessly. The CAPM model we write down is really a model of the determination of the market portfolio, not the determination of asset prices. And that's the way I think the world actually works when you think about, we don't live in an endowment economy, but it does take time and adjustment costs to invest in things. Just to close the sermon off, don't forget, there's always supply as well as demand. And this brings us back to like Leonard's first set of comments, where remember, Leonard had this great intuition that if there's traders who have to sell, prices are going to go down. And my first set of responses was, Leonard, you forgot about the arbitrageurs who are sitting around there ready to buy when you want to sell. But there's not just the arbitrageurs, there's also the suppliers of securities. So when people want to buy and sell, that doesn't just affect the incentives to arbitrageurs to come in and out, that affects the incentives of the other side of the market. And how easily can suppliers come in and produce more securities for people to hold. Buy, do good old-fashioned stuff, issuing equity, constructing new factories. Then the value of the stock market goes up by the amount of stuff going up, not just by the price of given stuff going up. And that's the way all markets work. Real estate markets, so real estate in Palo Alto, where I am right now, is going nuts. Why? Because a lot of people want to move in. Well, why don't they just build more houses? That's the way it's supposed to work, right? People move in, prices go up, there's a supply response. What should happen is the quantity of housing goes up, not the price goes up. Well, we have what's politely called adjustment costs, lots of zoning laws and regulations stopping people from building things. The result is the prices go up, and then slowly but surely the housing boom happens. So housing works exactly this way, and so do stock markets. Never forget the supply response. That was, again, one of those beautiful, all these questions are so beautiful they occasion sermons, but I thought that was a good one. Nina, it looks like you have some.
There is a related question from Eduardo from Peru. He asked, could you clarify a little more why does goodness of fit matters in APT and doesn't matter in general equilibrium models? Also, is testing a theory in the context of APT and general equilibrium models the same? What are the differences?
Okay, wait, I can't do two questions at once, but let's review. Let's take this as a chance to review what I said about the APT. The APT is so what we're because I don't want to go on record as having said goodness of fit is unimportant in any class of models, etc. But sorry. Let's think about what we're trying to do here. We have an asset pricing model. We have excess return equals alpha plus beta times factor t plus error t, and the status of this equation. This is a principal component. It's about variance. It says how much of the variance of return can I soak up with the variance of the factor. How much does, if the market goes up, how much does this stock go up, right? And we're trying to conclude that expected returns, E of R E, equals beta times E of F. I'm using a traded factor, i.e. that the alpha equals 0, right? That's the point of the APT. Now, the only difference between APT and equilibrium modeling, and it's kind of a religious one. It's about what holy water do we bless that conclusion about? Now, the APT makes a simple point. So equilibrium modeling, we start in with supply and demand and utility functions and willingness to bear risk and all this deep economics. The APT sort of takes a very trader point of view and says, let's look. This is a stock, and this is a bunch of portfolios I can use to hedge it. You know, this might be my new internet startup stock, and this might be the market, the tech portfolio, the oil price, you know, all the stuff that I can use to hedge it. And then the trader says, I don't care about margin utility and all this stuff. I'm going to form a hedge portfolio. I'm going to look at excess return minus beta times F. And that's no longer a regression. That is the investment I'm going to make, but that's my hedge portfolio that I'm going to use to reduce risk. And I'm going to look at that thing, and that's going to be alpha plus epsilon. And so with no utility, no nothing, just a trader perspective, you take the investment that you want to make, you take your ways of hedging it or financing it, the short position, all the stuff you can use to reduce risk and to just narrow in on that alpha opportunity. And the regression just describes that thing, and it says that the expected value of that is alpha, and the variance of that is the risk is the variance of the error terms. Okay, now let's move. That's how the trader looks at that possibility. And when do you buy? Well, you buy if alpha is really big compared to the risk, right? When you compute the Sharpe ratio and you go. Now we put the equilibrium hat on. Let the traders do what they want. What's going to happen here? What's going to happen here is if you have a market of competitive traders, they're not going to let big alphas with small sigmas sit around a long time. So we're making an equilibrium statement. We're saying how will if after all the trading happens and we finally wake up and get out of bed and have our coffee and look at the markets, where have the markets settled down? The markets have settled down to the point where big alphas with small sigmas are gone. It's too late. You should have gotten here, earlier in the morning if that's what you wanted. Now think about the logic. There's no utility functions. There's no aggregate anything. We've just said that where you can get big alphas with small epsilons, those things won't last long. So among securities with small epsilons, we should see small alphas. That's the logic of the APT. But so where does that work? That works where it says. So I should make it right. Small epsilon should imply small alpha, and to get that conclusion, I don't need a lot of utility functions. I just need traders who got up early in the morning and will take really outrageously good risks. That's only going to work, though, when I have securities. I'm only going to be able to use that if I have securities with small epsilons. That's where the goodness of fit comes in. Only when this regression has a high R squared is this insight that small epsilon implies small alpha going to be useful. Where the regression has a low R squared means a big epsilon. And with big epsilon, I can't say anything about alpha. Now I have to start thinking about people's willingness to bear diversifiable or undiversifiable risk and covariance with consumption and all that other stuff. So is that roughly the question? That certainly is the answer. Nina, help me. Does that translate to sort of to what Marla's question was?
I think yes.
Well, anyway, that's the answer. Maybe we should let Leonard or George. Do you guys have one last thing for us, either of you?
Yep, I have.
Okay, go, George.
Just one question before we're starting to think about general equilibrium. My question is, does the relationship between excess return and prices hold in general equilibrium?
What relationship between excess return and prices?
Sometimes we introduce in the lectures that the excess return should be the relationship between the excess returns and prices should be negative.
Okay, let's try now. Let me try this. So as always, got to formalize things. So certainly, so here's a relationship that's true always. So a return equals price t plus 1 plus dividend t plus 1 over price at t, right? So, so I'm making the. I think you asked a complicated question. I know a simple answer, and the simple answer is that if the price at t goes down, then the return t plus 1 goes up. Now that seems pretty simple. You'll notice when you read the Wall Street Journal, every time that they say bond prices go down and therefore yields go up, they seem like they have to explain this. But this apparently is it's not as obvious as I'm saying, or in the graph version. If we're thinking over time, where do you get your return from? There's price. You get return from price rising. So if the price goes down, the return goes up. Now that's not about general equilibrium. That's just a definition. Now, of course, I'm holding future prices constant. So holding expected future prices constant, a lower price today is a higher return today. Now that can't have been your question, but it is a useful answer for me to give anyway, in case that was somebody else's question. Now, in that context, what part of this were you thinking about involving general or partial equilibrium?
I was thinking about the general equilibrium. This is definitely holds in partial equilibrium. But what happens when, let's say, I want to secure myself from bad times, and the asset that is providing me this kind of insurance, sorry, all people are going to buy this, and then this will, in general, change the price, and then what happens between prices and excess returns?
Okay, now that's a good question, and that I think that comes down to yeah. So that's like one of our supply and demand questions. Suppose everybody wants to buy a security. Does that send the price? So if suppose everyone wants to buy something, yeah, everyone wants to buy the safe asset. It goes the other way around. So suppose we're sitting here. There's price today and price tomorrow. Everybody wants to buy. Does that send the price up and therefore the return down, or does that lead to more supply of the safe asset and you just get more of that stuff and more of that stuff at the same return? And that's exactly where general equilibrium matters. If there's a lot of people who want to buy something, it sends the price up if there's some limitation on supply. If, however, people want to buy something and supply can sweep in, then they just get more of the same thing at the same prices. If everybody in Greece decides to go take their money out of the bank, can they do it? That depends whether the European Central Bank will provide enough supply of money so they can do it. If there isn't enough cash, there is not enough cash in Greece for everyone to go to the bank and take their money out. So if they all try, bad things will happen unless there is a lot of supply. Sorry to make these jokes, but
is part of that related to information, because it relates back to what you were talking about building in, say, Palo Alto. If I'm naive and I'm just in the general economy and I want something, but I don't realize what it really takes to do it, and you're in the industry and you realize that there are all these frictions and you're not willing to supply that, is part of that due to the general person not realizing what it takes to supply the extra quantity?
No, here, Leonard, as usual, you've touched on something very deep and very important. So I mentioned that our markets are also markets for information. And that's an aspect of asset pricing that I'm completely leaving out of this class just because we only have so many weeks. But it's vitally important. So if somebody shows up and says, I want to sell, in a supply and demand kind of market, the way we're thinking about it, everyone says, okay, you want to sell, we want to buy, what is it? Because we know what the good is. Asset markets, if somebody shows up and says, I want to sell, everybody says, wait a minute, what do you know that we don't know? And so the source of price impact, the source of bid-ask spreads, the source of so much interesting stuff that goes on in markets is that if I show up with a truck of tomatoes, everyone says, oh, a truck of tomatoes, sure. Tomatoes $3.50 a pound, maybe I want them, maybe I don't. I show up with a truck of stocks, and they say, oh, what do you know that we don't know? And so them inferring from the fact that you're trying to sell that you might know something that they don't know, that can lead to the whole price collapsing. So that's the whole asymmetric theory of asymmetric information, theory of information trading. We can do a whole Coursera course on the whole thing. I'm not going to start it today, other than to highlight I'm not talking about that in this class, but it is very important, and that's the second class you should take is a class in that sort of stuff. Mm-hmm. So as usual, Leonard asked the deep questions. Thanks, George. Thanks, Leonard. Thanks, Adam. Thanks, Nina. Thanks, everyone, for watching. We'll see you again next week when we do. Next week is GMM, right? Yeah. That should be fun. Okay. Bye, everybody.
Bye-bye.